$125 billion. That's how much was pushed into one index fund in the year 2025. Retail investors are convinced that the bull run is not going to end, but they're buying in at all-time highs. Meanwhile, 1.2 million jobs were cut last year, and unemployment just hit 4.6%. This has been triggering the SOM rule. Now, for those of you who don't know, the SOM rule is a recession indicator that has never been wrong in 50 years. And yet, money keeps flooding into stocks. This is the same exact pattern we saw in October 2007, right before the financial crisis. The Fed was cutting rates, investors were piling in with record margin debt, and unemployment was starting to tick up. This is when everything started to collapse because we started seeing things tick up very quickly. So, this is the biggest trap in potentially in financial history. And it's being set right now because if you're buying stocks, you need to understand exactly how this trap works, who set it, and whether we're at the peak or if there's still time before it all comes crashing down. So I'm going to go through and go into everything that we have right here as to why I believe that this is the trap and what we need to do in order to avoid this. Now, first, we need to look at the potential of some of this, so we've got some of this core thesis here where the retail investors are rushing into this because there's a lot of economy cracks that we're starting to see right now. So the pattern that we see is this economic cycle, right? So if you see the upsells and downsells, you see the unemployment rate drastically starting to tick up. Look at that, up to 4.6% in November. Now, if you look at all this, October 2007, S&P 500 was making all-time highs. Now it is making all-time highs right now as well. And in October 2007, the Fed was cutting interest rates to hold cash as well. So the Fed and 2008 and what was going on in the market had a lot of similarities as it did right now because investors accumulated $150 billion in margin and debt in the last final stages. And then unemployment started ticking up. And then, boom, the financial crisis. So we see here in this chart that the S&P 500 was, peaking here around 2007, right? Started to peak. And then it, as Kanye West says, it all falls down shortly thereafter. So that was when the unemployment rate started to tick up and that marginal debt started exploding. So now we have $125 billion that has gone into the single VOO or the S&P 500 index fund. Unemployment is now up to 4.6%. And that margin debt is exploding all over again. So I got to ask the question, are we in October 2007 all over again? Is this something where we could see potentially it starting to quote unquote all fall down here very shortly? Now, when we keep looking at the unemployments, obviously we had the big spike up with the cerveza sickness, but look, it started to crawl its way up and it looked an awful lot like what we're starting to see right here in early 2001. And then, of course, right here, what we're starting to see in 2007, right before the unemployment absolutely exploded. So during that time, the S&P 500, the PE ratio for everything was 22.5, which was one of the most expensive points in history. Now we have a high PE ratio for the S&P 500 as well, where we're seeing, pretty similar to what we had back in 2007, right? So we see it start to drastically tick back up. And then it was at 21.2. Now we're at 30.9, 31. So it's becoming more expensive, right? So at current valuation, the S&P 500 is expected to return over the next 10 years, basically $0, right? 0%. The PE ratio doesn't tell us if we're at the exact peak, but the PE ratio versus the 1 year returns don't show any correlation because the short-term price movements of the market are tough to grasp, I guess, let's say. But you can buy expensive and still see some short-term gains. but you could buy cheap and see losses in the short term as well. So we know that retail is buying near the top, but are we at the top right now? Because we got to keep asking that question. If we're in a bubble, when does this bubble pop? Because the S&P 500 earnings haven't declined, they've actually accelerated, which I think is very interesting. The tech sector's earnings were actually up by 21% all of 2025. And the AI investment boom mirrors the late 1990s or the internet boom. So, saying all of this, is this a boom or is this a bubble? It's really what we got to ask, as we're diving in here, because the S&P 500 now and the S&P 500 chart is still, on that upward trend. Of course, we see these little dips here in the road, but if you zoom out, it is always up and to the right, it seems, right? So the 1990s parallel, it doesn't look like 2008. It looks actually like 1999, where the dot-com bubble didn't pop until the Fed raised again. And right now, the Fed is still cutting rates. I mean, if you look at the federal funds rate during this time as well, right? The Fed was raising and then they all of a sudden started cutting. And that's when you saw the bubbles pop, right? Is when the Fed started cutting. It's interesting. The Fed is always cutting into recessions when people think that this would help, right? So now the Fed is cutting rates in December 2025. They're stimulating, not tightening. If this is like 1999, there might have some room to run still. And history tells us when the Fed starts raising again, that's when the trap snaps shut. The Fed rate hikes equals the liquidity drain, and then it equals more expensive stocks that can't sustain. Then it goes into a crash. So if the Fed keeps cutting through 2026, the bull market continues, but it gets more dangerous. When the Fed pivots to rate hikes, that's your warning sign, right? Then it's too late for retail to jump on in. They're already all in at the top, right? Retail investors have been buying, and they keep on buying even with this PE ratio at 30.9. They're being incentivized to buy at the worst possible valuation. And so when this all unwinds, you could potentially lose decades of return because of how much we've seen drop, right? So when we take in and look at the SOM rule, this is where we see a lot of the potential negatives here, because here's the trap in one sentence. The Fed cuts rates to stimulate a slowing economy which pushes you out of cash and into stocks at the highest valuations in history, right before the economy contracts and stocks crash. This happened in 2007. It happened in 2000, and I believe it's happening right now. 125 billion flowed into just one S&P 500 stock index fund in 2025 as unemployment is continuing to rise at 4.6%. So retail is all in, and the trap for all this has been set. So the question is are we at the exact peak, or does this look more like late 1999 and we still have one more leg up before the crash? Based on the Fed's policy, they're cutting right now and not hiking. But if you look at the CME group and how they're looking at this, they're actually looking at us potentially pausing here. And when we look back at history, when there's a lot of stop, start, that's like the late 1970s when we had hyperinflation. Okay, granted, it wasn't hyperinflation, but we had stagflation, right? It was not a very good time for the overall US economy when we went stop, start. So, is the Fed going to make the right decision? The real answer to all of this is the Fed and the governmental policies. It's run by humans, and humans by nature are imperfect, right? We make a lot of short-term decisions. This is why you see the population extremely obese, right? This is why you see people who just show up and do things consistently for a long period of time. Those are the ones who ended up winning. Why? Because you might not see the results early on, but the people that wait and see that delayed gratification, that's where you see the biggest results late in all of this, right? So the Fed making these decisions, they got to put money on the table, right? They got to keep their jobs, folks. So because they got to keep their jobs and keep on looking at all these things, they're making those short-term decisions. And some of those short-term decisions include cutting interest rates when inflation is still hot, Cutting interest rates when, the Dixie is not looking the best. Cutting interest rates, even though we have all-time highs in the S&P 500. I mean, if you look at the Dixie right now, it's at 98.3, right? Last year, it had one of the worst years in the last decade. Year to date, the dollar is basically flat right now, right? I mean, hey, we're not looking for big returns on the Dixie here on January 5th, right? We're not. But if you look at it in the last year, it's nearly down 10% in the entire year, right? But Trump just made a big move to potentially, increase that dollar by getting a bunch of natural resources. And the S&P 500 is still tricking along. I mean, we're closing the day. Yes, we're past market close. We're closing the day at 6,900. We're going to see 7,000 for the S&P 500 here pretty soon, folks. It's not slowing down. The market conditions are showing that, hey, we're all going to, I mean, like it's not, I'm making this video essentially to preface you what is ahead, right? Because we do have an overinflated economy as it stands right now. But when you take a step back, right, $125 billion or $125 billion inflows into one S&P 500 index fund, $20 billion in recent inflows, $1.2 million in job cuts in 2025, something isn't adding up, right? We saw a bunch of jobs revisions. 4.6% as the current unemployment rate, which has triggered that SOM rule. And the S&P 500 PE ratio is over 30. So we see a lot of imbalance in the market. And that imbalance in the market eventually is going to tip over to the side, into the negative side. So sure, do we still have some runway maybe left in this market? Maybe we do. But I'm making this video to show you guys that there is something that is underneath the surface that is showing some signs of cracks. I cover all of this in my Skool community as well, so be sure you guys check that out. I'm going to give a certain the rate that it's at right now to the first 100 people that joined. So if you guys enjoy my work, please feel free to at least like, comment, let me know what you guys think, and if you guys want to join the community, I'm all open for that. So I'll catch you guys all at the next one.